I'm Christina Dolan, and I'm the moderator today, and I've been involved in the blockchain stablecoins for longer than I care to admit, but the first initiative that I got involved with, one of them was actually in the risk assessment for insurance companies, and I do remember going to the London market, and there was sort of like a feeling that you didn't need to have different sort of risk metrics for blockchain technologies, and fast forward here 11 years later, and here we are. So we have an interesting panel on building secure stablecoin ecosystems, and I'm going to ask each of the panelists to introduce themselves. So let's start with Charles.
Hi everyone, I'm Charles. I've been with SocGen for 15 years. I'm now in charge of digital assets activities in the US. Maybe just a quick word on Société Générale. So it's a French bank. We started working on I would say blockchain, generally speaking, 5-6 years ago, with bonds issued on Ethereum and Tezos. So one of the things that sets us apart is that we've always worked on public chains since the beginning. And more recently, we've launched our own stablecoins in euro and dollar in Europe under MiCA. Again, on a public blockchain. So it's available on Ethereum, Solana, Ripple, and soon Stellar.
Good morning, everyone. My name is Chris Lalonde. I'm Chief Legal Officer at One Money. We're a stablecoin infrastructure company, so we provide a full end-to-end stack with respect to stablecoins from orchestration layer platforms on a global basis, and we're also developing a layer one purpose-built for stablecoins and real-world assets. From a stablecoin issuer perspective, prior to joining One Money, I was a global head of the regulatory and product legal team at Circle as we were expanding USDC around the world.
Hey, I'm Simon Jones. I'm the Chief Commercial Officer at Banks. We're effectively the market leader in direct push-to-pay from wallets. So we were the first people to actually physically connect an on-chain debit card to an on-chain wallet, which we did with MetaMask. We've really been kind of pioneering and pushing into the account abstraction space and how you can really start to link any store of value to be spendable. So obviously that becomes specifically relevant within the stablecoin world. Because fundamentally it's about how you digitalize what was traditionally analog flow, and in theory how you can make bankless payments through stablecoins. We've been around since 2018. We work with a bunch of market leaders like Ledger, MetaMask, 1inch, Exodus, Trust Wallet, various other people. And I think what's specifically interesting for us is now to see how the market has kind of come towards the ideology that we first set out in 2018, because we wanted to do direct push to pay from stables or direct push to pay from crypto. And we weren't allowed. Now we're starting to see these frameworks and this evolution coming around and all these new challenges coming into the world. So particularly interested in kind of how that sits in the context of security structure, risk regulation, and framework.
Good day, everyone. My name is Anthony Howell. I am the overseas representative for the government of Bermuda. I'm the director of our Washington, D.C. office and liaison here to the United States. Bermuda is a jurisdiction that prides itself on being very innovative within the tech space when it comes to digital assets and cryptocurrencies. We've written regulation, namely the DABA, which is a Digital Asset and Business Act, which was written back in 2018. We've become a model, I believe, and I think most of our team will believe, and really do follow that in suit, that we've pushed the boundaries in what results in clarity. This is what companies need and what companies want. And this is what the industry itself wants, and I'm happy to be here. And just a forewarning, I can't speak for the regulator as I'm not a regulator, but I will definitely delve into a bit of what Bermuda's regulator has been doing and how we are very much in this space. So thank you.
So thank you. So you can see we have a really great panel. So let's start. I mean, when you think about these secure, stable ecosystems, they're kind of a bridge between sort of the traditional financial environments, and you've got this very efficient type of technology that's sort of revolutionizing financial systems. And so it's kind of a jarring effect and moving at the speed of light. And so how should enterprises require both the initial certification and the ongoing attestation to ensure long-term integrity, especially since some regulators are in fear of this sort of front-loading of sort of regulatory compliance and maybe not as much ongoing regulatory compliance?
I can start with that. Well, I think, certainly, I think fundamentally, now that we have the Genius Act here in the United States, we have the MiCA framework in the EU, We have a variety of regulatory frameworks in the UAE, Hong Kong Stablecoin Ordinance, Singapore, et cetera. I think the frameworks are there globally to mandate the appropriate levels of certification and attestation, and I think that especially when you look at something like the Genius Act, where any stablecoin issuer is deemed a financial institution, it's incumbent upon those issuers, those permitted payment stablecoin issuers, to meet the market and meet the users, where they should, as in terms of being an upstanding financial institution with the appropriate certification attestation standards that are now written in the law.
Thanks. So who wants to add to that?
Maybe just quickly on my side, we've launched our Euro stablecoin before MiCA in Europe, and it was actually quite a nightmare from a bank perspective to issue a product without an appropriate regulatory framework. And so it took us 18 months to get internal approvals to launch a product that didn't fall under an appropriate legal framework or regulatory framework. And at the time when we structured the product, the subject was, how can we create a stablecoin that is not a security, but you still need to give the promise to repay investors one for one and to give them this assurance that they will get their money back. But it mustn't be a security. So it's not a debt product and it's not a fund, but you need to give that people confidence. And so on our side, so we developed a very complex structure and it worked. But the fact for us that MiCA arrived and put everyone a regulatory framework, gave everyone's comfort in the rules that we had to follow, and that the regulators were allowing us to move forward with these products.
It's interesting. If I could just add on really quick there, just because I know the regulator in Bermuda had issued a guidance back in, I think it was November 2024, on a single currency pegged stablecoin. So, again, the way we look at it and the way the regulator operates is that we have to look at different case studies and to see which is going to be most applicable to the company's ability to fulfill their actions and what the company is looking for, while also maintaining the scope within a regulatory standing. And so, it's important for the regulators to have this kind of clarity and systems broken out and have that standard set, so that way that when companies operate in those jurisdictions, there is no confusion onto what they can and cannot do. Because again, companies that are investing, in some cases millions of dollars, even more so, don't want to upend themselves and have to go to another jurisdiction just because the one they're currently in does not set that standard correctly. So I think that's very important to this kind of conversation.
Right. And I can add to what Simon said. I can fully appreciate that. When we issued USDC starting back in 2018 and launched Eurocoin in 2022, and we were in the exact same boat as banks, right? Not knowing what the regulatory framework would end up looking like, not just here, but also from a federal perspective, but also in the EU and everywhere else around the world. So, the idea, the goal, utilizing at least the framework that was in place with the DFS's, virtual currency guidance, with the money transmitter framework here in the United States, we tried to use our best approximation of what a well-trusted stablecoin would look like, and what reserve requirements, proof of liability, proof of reserve, attestation requirements would be expected of us, and we certainly treated ourselves as a financial institution when we launched those products.
Which is a great point, because there's so many layers in this, right? I mean, it's not like AML, KYC, et cetera. I mean, traditional institutions, financial institutions, just sort of have an on-ramp to ensure where the money has come from, and they can only look back to the previous silo, really. And then there's like the transmitter and all the other types of regulations. But now you have a certain level of technology that could be somewhat expensive, that gives you a certain type of visibility. So what data should the regulators monitor in real time? I mean, you can monitor everything, but the expense of that would be huge. So there should be some parity between sort of the risk, which is, I chair the audit committee in a public company, and I'm also in the cybersecurity space. You look at NIST and these traditional risk metrics. It's always like you go through the process of figuring out like what are the highest risks in your particular scenario. And Simon, we had an interesting conversation before, so I'm going to call on you next on that. But it is expensive. You could do a lot of things, and traditionally in risk management, whether it be cyber, whether it be an audit committee, you prioritize that based on certain criteria. So I'd like to hear, what your thoughts are on what the regulators should monitor in real time.
So it's an interesting question because in theory they can monitor everything, right? It's on chain. So to some extent it's an educational point, right? You have to some extent go to regulators and say, actually, there's this different parallel system in which you have full visibility and full transparency, but you won't necessarily understand what it's about or why it's moved, right? So I think, first and foremost, you really have to go back to first principles and say, well, look, if I was a bank or I was moving money around the world as a large, corporate, what do I do? So I create policy, I create framework, I create structure, and I prove that I'm working to rule. Now, the interesting thing in the world that we're moving into is that fundamentally we have lived in a world of trust. And that trust has been that, if someone writes you a cashier's check, it will be honored. We're now moving into a world of verification because, in fact, in theory, in real time, you get real-time verification, real-time notification, real-time settlement, and everything else happens in an instant. Now, you can't just stop a system, right? That's the issue with real-time. That's a lot of the reason why we don't have real-time payments in a lot of parts of the world, especially America. Because fundamentally, there is this idea that you have to slow it down to be able to check. So what you need to think about, and what really people like us in this room need to think about, is how do we actually kind of look at proof of actor, right? I.e., who is the person, who is the individual, how are they behaving, and how are they, operating? Should they be allowed into the financial system? Because everybody's talking at the moment about things like agentic commerce, right? And by the way, I'll tell you right now that 402 does not work, despite the fact that everyone will tell you that. I tried it 20 years ago when I was at Facebook. It doesn't work. It still won't work today. But you're moving towards this world where you've got a multiple different range of actors. In theory, you are globalizing payments as opposed to localizing them, because payments have always been a regional thing. American systems are different to European systems, are different to Chinese systems, are different to other systems in the world. But once you start to digitalize that, you go over the top. So what we're really talking about here is how you're building the orchestration layer. And that orchestration layer becomes the orchestration layer for the global world of finance. And that's going to mean that you're going to have to start to introduce all these different new concepts. For example, proof of personhood, because it's real. Is it a bot? Well, no, we don't want it to be a bot, right? We want it to be a person. And if it is a bot, we want to prove that it's a bot that was configured by a person to do the thing that it wanted to do. Otherwise, you get a huge rise in friendly fraud. So when you think about where we're at now, in terms of the stack, really the stablecoin piece is the enabler. What comes next is the bit that really then everyone has to build their frameworks, their policies, and their procedures around, because we're digitalizing something. And one thing I say a lot to people is if you look at traditional banking, credit and debit, it was invented in 1397 by the Bank of Medici, and we're still fundamentally following the same principles. Think about that when you sat here today. What other system do we use today that fundamentally hasn't really evolved? Yes, it's digitalized, yes, it's done different things, but the core concepts and the core principles haven't changed. And the really interesting thing where we are now is that you're actually going to start to see a return of capital control towards the people that actually use it, or people that own money, as opposed to centralization. And that really sparks a huge range of different things that regulators are going to either have to suck up and accept as a risk, or they're going to have to try and adapt a framework around.
Very good. Does anybody want to add to that?
Yeah, I'll jump in as well. I think it's important too because you have liquidity, but on the other side, I want to talk quick on cybersecurity because I also think that's actually one of the things that the regulators are definitely going to want to be able to have real-time visibility on. Is there's any downtime or any the time it takes for a company to come back online from a cyber attack or anything of that nature. Again, when you have a lot of information that's stored within these data fields, the regulator wants to ensure that there's going to be processes in place in order to protect the company, but also protect the individual's data. So, those are, I think these are becoming the more key, especially since the data is becoming more and more synthesized into the identity markers. I probably stray a little bit, but I know in Bermuda we're looking at digital identity now. And again, when we're putting these into practices, codifying these into singular points, if we're going to use one singular point for one data identity data identification system per se, you want to make sure that that is very well protected. We've seen time and time again how cybersecurity is one of the biggest risks out there. Data hacks are very, very common. And so with these kind of systems in place, we want to ensure that if we're really linking everyone's information and just, through companies, and stablecoin could be the first block to that. But again, as technology progresses and the ideas progress, we want to ensure that the industry is well regulated enough to ensure that there are protections in place to protect it as much as possible, because once that breach is there, it's very hard to unwind it.
And if I can make a plug for the BMA, because we're licensed in Bermuda, as well as Circle, or as is Circle. So, the BMA has actually been really proactive about things like that. Just 2 weeks ago, AWS outage. So, one of the things that BMA did proactively was actually reach out to all its licensees to inquire into any impacts. I actually didn't see that from other regulators, and so I think when you're thinking about something holistically, given that stablecoins are very multi-dimensional in nature, just like any other major financial infrastructure. If you're from a regulator's perspective, you want to be looking at not just the entirety of the ecosystem, but particular things like outages, cyber incidents, just like threat intelligence. A lot of regulators and law enforcement agencies these days subscribe to the same blockchain analytics firms that a lot of the issuers do as well. So a lot of the major ones like the Elliptics, the TRMs, the chain analysis of the world, these are things that can provide regulators real-time information on what the issuers themselves are also seeing.
So Charles, I saw you move your mic. Did you want to add to that?
Yeah, just very briefly. I remember discussions that I've had with our compliance teams back in the days when we launched the stablecoin. Their point was, as a bank, when your client comes to you and wants to deposit dollar bills, you ask what his activities is and where the dollar comes from. And so you analyze the answer, but that's it. But now, because you have access to more information, you are expected to use this information and to leverage that information to protect yourself from regulators, prosecution, or additional questions. And that, I think, is a key thing in the discussions with regulators, to really understand their expectations. How many hops do you need to analyze? What depth do you need to go to in terms of compliance analysis, just to make sure that you're doing your business in a safe way.
Which is a good point, because traditional banking only is able to look one hop, right? And so the question becomes, what is this dashboard going to look like in general? I mean, obviously you're innovating before these regulations come about, but I would say the financial regulators are probably the most aggressive of all in terms of fines and punishment, let's say. So I do think that this, as you've all commented, there's multiple layers. You have the cybersecurity layer, you have the traditional banking in terms of where the money's come from and managing where the funds are coming from, and then you have all of the sort of liquidity risk aspects of that, which in and of itself is a level beyond what you can even manage in a regular financial system. And you start adding that up, becomes really expensive. So let's shift a little bit, because I think Christopher actually touched on this before with respect to how do we balance privacy and transparency in the stablecoin system. So anybody want to jump in? No.
I don't think privacy and transparency are necessarily mutually exclusive, right? I think one of the cool things about blockchain technology and the stablecoins is that you have this level of transparency, right? But at the same time, we have technology nowadays, like ZK KYC, ZK proofs, that actually allow you to prove the identity of somebody without revealing their specific identity. So you can actually, I would argue that the technology that the stablecoin industry offers, is well above and beyond what the banking industry could ever offer in like a fiat context, right? In terms of finding, where the money moves and who's moving the money. So, but, you can definitely balance that, especially with the technology today.
Yeah, absolutely. And I think one of the pieces to add to that as well, and you touched on it, is identity, right? The key really to unlocking all of this world is always going to be identity. So, if you think about from a perspective of, when I go and make a transaction through a bank, right? Well, my bank have checked me, they know who I am, they think I'm okay, and that's what they'll tell their regulator. They've worked to the policy. Now, in theory, there's no reason why you can't create a digital version of that, i.e. a digital persona of yourself. So you could use something like a JWT key standard, which effectively means that you create a credential, a digital persona of yourself, you put that on chain, you hash it, you encrypt it. But then at that point, I've effectively self-published my digital identity. But when I'm interacting with a financial institution, they can collect the metadata from that credential to prove who I am. And actually, in that world, you end up with real-time attestation on chain, which if people really understand how to use that, is such a powerful tool. Because in theory, you don't need to be able to blacklist someone. You can just shut them down, right? You can take away their identity because they have proven themselves to be a bad actor. And actually, that's where when people look at this space as a threat, in reality, you can pull a lot more data in real time than you can out of a banking system. It should be seen as a positive. But the key to unlocking all these things, we have stuff like passkeys, which are a great foundation layer for biometric data to be collected. But the key to everything is how you get an accepted identity standard that you can use in a digital world so that you can go back to the principles of ZKP and you can know because you know and you can prove it.
I'll just say from the regulatory side as well, the information that the regulator usually requires and will always seek out for is for proof. But at the same time, they also want to make sure that the information for the individuals that is held, it's protected. So it has to be that interesting balance between being transparent enough for the regulator to understand the business is operating in the way it should be operating, but also in that same standing that the information does not necessarily need to be shared if it's very private for privacy concerns with the persons involved in the clients and what have you. So I think that's a very interesting point.
And you already have that like these days, right? You have, if you're a financial institution or an MSB, for example, I mean, you have to abide by the travel rule, right? So, these financial institutions are already trading that information, and the way you do it is you just keep the personal information offline or off chain, right? So you're representing an identity with hashes rather than someone's SSN or their name. So that's already being done, but. The point I was making earlier is that there's even better, solutions as of today that, can, provide that real-time information directly to, again, issuers, auditors, regulators, law enforcement.
Exactly. So, so since this conference is about trust, what metrics will define trust in programmable money?
Everything.
Well, I do think that one area that we haven't talked about is making sure that the reserves, from a risk perspective, are in an investment vehicle that allows for the level of value to represent, that needs to be represented is actually represented. And so that's another complexity in this layered system.
Yeah, maybe very briefly on that. And you may have seen that most of the regulations will ask issuers to publish their, collateral reserve reports, which is great. But the reserve composition, but you don't know the custodians. Yeah. And I mean, and on our side, we just keep cash as collateral reserve, and we do publish the name of the banks that are custodian banks. But I think that the main risk as an issuer. As a holder, of a stablecoin, so okay, you have the risk on the issuer, but at the end of the day, it's where the cash sits or the reserve sits. And it's nice to know that you have 100% cash, but if it's at BNY, it's not the same as if it's a third-level bank. And so I think these kind of information are key and not yet public in most of the situations.
Totally agree. Did you want to add? I see some mics moving up. Anthony.
I'll jump in just because I think I mentioned earlier with the guidance that that was set up back in 2024. I think they issued a 1-to-1 for high value quality. So, the expectation there is to have at least a 1-to-1 unit there because you do want to have the reserves capable to fund whatever is going on at the outset. It is just for liquidity purposes. But I do think that one of the measurements for trust is having a stability there with something that's pegged definitively to an amount.
I mean, the reserve requirements, like a lot of the other things, are now codified, right? So whether again in MiCA, pick any regulatory framework around the globe. Same thing with Genius, right? And on top of that, in terms of metrics. Now that any permitted payment stablecoin issuer is going to be treated as a financial institution, they're going to be prudentially regulated by either their the state regulator that they issue under, or the OCC, right? So so through the examination process, a regulator is not just going to look at your reserves, which also have to be attested to on a monthly basis by by a registered accounting firm, but you have to make certifications under penalty of perjury and at the risk of violating federal law. But they're going to look at everything, right? They're going to look at your cyber controls, your smart contracts, your audit logs for your smart contract audits, et cetera. So the DFS has been really great about implementing the virtual currencies, the bit license regs years ago that set forth the gold standard that a lot of which you're now seeing in the Genius Act, and I think you're going to see in the rules coming out within the next year.
I see your mic going up. Simon, did you want to add to that?
All I was going to say was, to me, the question when you look at success and you look at trust is really about a question of platform and distribution, right? So you can look at it from a reg perspective, but you can also look at it from the baseline perspective that every year globally, there's roughly $4 trillion that is consumed by the act of paying or the act of holding a bank account, right? So if you look at the moment, it's about $2 trillion a year globally is spent on people just to be paid. So if you're a merchant, that's the kind of fee that you pay to a card network, right? So actually, if you can start to redistribute that, to me, that's actually the bigger trust metric that you should be building, because that actually gives the benefit back to the people who own the money and actually starts to re-platform the system. That is a bigger win on trust to me than anything that's going to come from a regulator.
So we have 3.5 minutes, and so I'm going to finish off with this one question. We're going to do this sort of like a lightning round. And so let's conclude with 2 concrete actions to make stablecoin ecosystems safer for regulators and users alike. So do we want to start over here with Charles?
I would like to see like a deposit insurance scheme on stablecoins, like what we have on cash. I wouldn't be surprised to see stablecoin issuers to contribute to this kind of insurance scheme, either in the US or in the EU. And the second thing is, going back to my point earlier, collateral guidelines that are not just defining like liquidity metrics and requirements, but also kind of counterparty risk or custodian risk more precisely.
In terms of 2 concrete actions, I think, the timing is kind of serendipitous because the rules for Genius, and at least in the U.S., are being written right now. So, I think as I mentioned earlier, with like the technology that's out there for real-time reporting, I think one concrete action would be for in the rules, regulators could actually mandate a certain level of real-time API feeds or real-time reporting on reserve quality, reserve compositions. And then, a lot of these regulatory frameworks are at their core consumer protection laws. So I think it just comes down to fair disclosure as well. And, a good stablecoin issuer worth their salt is going to be very transparent and very conspicuous with, what they're offering to the public, whether it's a retail user or a commercial user.
I think you've got to add to your point, Chris. I think, from my perspective, I think you've got to see regulators start to actually allow smart contracts to govern the relationship between the consumer and a merchant, right? So if you can actually, codify that, make sure that code is law, and ostensibly have the whole thing managed digitally, linked to a stablecoin. In fact, in theory, that contract is binding, and you can write frameworks that actually ensure consumer protection, because the redemption mechanism is automated and it's assured, right? That would be my first point. I think my second point would be that what I see at the moment, we work in 60-odd countries, is a huge amount of atomization, right? I mean, as an industry, we're guilty of it ourselves. We like to go off and build everything everywhere. But actually, from a regulatory perspective, I do think there needs to be some kind of consortia or some kind of standards body built out. Like if you look at the internet, it's managed by the W3C Council, which is the body that effectively governs the internet. I think we need to think similar in this space, where you can actually start to make sure that you don't get too much regulatory divergence. Because the point here is that stablecoins are a global asset. They're a digital asset that can move around the world. And of course, in any system, you're only as strong as the weakest participant. So if somewhere like America has a very strong system, somewhere else doesn't, then you need to be able to build some baseline standard.
Yeah, how do I follow all that? No, there's some fantastic points. You know, it's actually interesting when I think segregated bankruptcy reserves along with tested wind down. I think that would be a key one there. Actually, that was something that was discussed a bit when I had some internal discussions with some non-regulated members of the community. Again, because you do have a lot of companies that are entering into the space. There is a lot of movement going to different jurisdictions to set up shop. And you want to ensure that if a company decides that it's time to wind down, that there is correct protocol in place, that counts as segregated so that wind down can actually take place properly. And I think otherwise it would be a nightmare for the regulator. So I think that would be something of value. And I agree with everyone else's statements up here.
Well, thank you, Charles, Christopher, Simon, and Anthony. Great panel. And with that, we conclude.